Joining me now is Joe Hegner. He's the founder and CIO at Asterozoa Capital. Welcome to the show.
Thanks for having me.
All right, so as the session starts, what are you going to be following most closely today, Joe?
I think today in particular with the GDP print and the jobless claims, we're going to be laser focused on the 10-year and the 30-year Treasury rate and where the long end of the yield curve is headed. If it's going to be kind of trending higher or if it stays relatively well bid, I think that'll be a good indication about how the market might be digesting where the Fed might be heading and where the S&P might be heading over the next 6 to 12 months.
All right, and I understand that you see equity markets generating 30% returns over the next couple of years. What do you think, what are the factors contributing to this?
So I generally, speaking, we're drawing a lot of parallels between what's happening right now with AI and innovation and technology and the dot-com bubble. And, in terms of, a comparison or where we are within that time frame, I kind of feel like we're in 1996, 1997, and we're just really about to get started here. Remember, there were tons of professionals and analysts, even in 1996, who were pounding the table saying we're in an internet bubble. And they were right. But if you got short in 1996, you got your head handed to you, right? You didn't exist after a year or two. And you missed out on 40% equity market returns for several years if you were following that bubble. And I think that we're in a very similar situation. That bubble lasted for 5 years. The only thing that killed it was when the Fed raised rates, right, in 2000. And we're cutting rates right now. And there's $4 trillion of fiscal stimulus coming down the pike. We have full employment. Stock markets are all-time highs. I think it's very difficult to make the argument right now that, particularly this morning with a 3.8% GDP print, I think it's really difficult to make the argument that the Fed should be aggressively cutting rates and that we might be headed into a recession. And so I think there's a lot of risk to the upside that the bubble continues to inflate. At some point, that party stops and, you got to find a chair in the musical chairs game. But I don't think it's anytime soon.
What's your take on the Fed's latest move, the 25 basis point cut, and what do you think will happen for the rest of the year and potentially into 2026?
It's a little troubling to see how kind of polarized the Fed Board of Governors have become. If you look at the dots, there are several voting members within the Fed who are biased towards keeping rates kind of where they are until there's more data where we're absolutely sure that we've quelled inflation. And then you've got sort of a hostile takeover of the Fed via this administration. And their agenda is to cut rates aggressively. And so you see this kind of polarization, and Trump is going to hand select the Fed chair next year. So into 2026, I do think that the Fed's going to lean very, very dovish relative to, maybe a more neutral posturing.
And back to jobless claims, what's your take on the data that came out this morning?
Well, that's data that we're nowhere near a recession, right? And even as job numbers do somewhat deteriorate, it's unclear to me if that's a function of recession or if it's a function of efficiency and productivity gains via AI and those embedded tools, right? If I own and run a law firm and I don't need to hire 200 analysts anymore because I can hire 5 and leverage AI tools, my efficiency has massively increased, my productivity has increased, my equity value or my stock value has gone up quite a bit, and yet the jobs numbers are going to look really weak. And I think it's unclear to me how much of that is taking place, but it's something to be aware of. That's a structural shift in the way that this economy is going to be run, and the Fed's overnight rate isn't going to be able to do anything to take care of that structural change that's taking place.
What do you expect in next Friday's jobs report?
Oh, man. I would expect to see, relatively strong or inline numbers. I don't expect to see any kind of blowout numbers to the upside or the downside. It's kind of a cop-out answer, to be honest with you. But generally speaking, I think the macro economy is fairly strong. And even though we are seeing some deterioration in the kind of the more subprime style borrowers, right? This economy these days, right? 50% of all U.S. consumption is done by the top 10% of households in terms of income, right? And so this economy, particularly large cap corporations, they're increasingly more reliant on the more affluent in this nation, and that's a troubling situation from a socioeconomic standpoint, and for a democracy, right? But in terms of valuations and stock markets, it's supportive.
And you just mentioned AI before. What are you following most closely? Obviously, it's making very big headlines here on Wall Street. What's your takeaway?
Yeah, in terms of AI, these kind of circular deals that we're seeing across a lot of large companies is somewhat, it's very interesting. And there are some parallels to 1998, 1999. We want to keep an eye on that. In terms of the massive amount of infrastructure that's going to be required in order to meet some of these hockey stick projections that are being touted in financial media, I'm somewhat skeptical or dubious that that's possible, or just the energy alone that would be required, right? If you look at the most recent, one of the more recent deals, 4.5 gigawatts of power to be supplied to OpenAI, that would require Oracle to, I believe, build out 188 new data centers, which would be unbelievable if they could do that, and I'm sure they will over time, but that deal is set to begin in less than 18 months from now. It's a very tight time frame to build out almost 200 data centers, let alone where are we going to get the power and the clean water to support that infrastructure. So there's a lot of questions, I think, that are still outstanding as it relates to how we're going to accomplish some of these very, very parabolic projections.
Joe Hegnar, founder and CIO at Asterozoa Capital. Thank you so much for joining us.
Thank you.